Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, May 21st, 2025. It is 12:19 p.m. Eastern Time. I'm starting the video, so we're about smack in the middle of the trading day. Not a whole lot going on trade idea-wise lately, so I just wanted to update those trade ideas that I have thrown out in the last week or so. And I also want to wrap the video up covering both Treasury bonds and the equity markets because they're at this point in time, more so than most, they're very, very much related right now, and I'll get to that in a second. I'm talking about my zones that I've given you going back for, oh gosh, it's over a year now on the 10-year Treasury bond via IEF. So I'm going to get to that. That has direct implications, I believe, on the stock market as it has in the past since I've started pointing out those levels. So we'll do the stock market at the end. Again, this week we've had literally two trade ideas thrown out to you. Oh, well, we had going back to even the week before. Remember, it's been light. We've had GDX hit the second price target on the 15th in pre-market where I favored a bounce. That's what we got. So I may highlight that one again as a new objective short entry. If time permitting, you know what, let me add that to my notepad. If I get through the video, I'll update the dollar, gold, and GDX as well because, again, it had a perfect bounce right off that target and maybe time to look at a re-entry or add back on there if you're in that one. Okay, so other than that, starting out this week, on Monday, we hit the final price target on natural gas for a 12+% drop. We shorted right there at the breakdown of that wedge. Hit T4 and then some on Monday, and that's it. So I updated that one yesterday. I said if we get down to this level and crude gets up to the resistance level I highlighted, that may be my next trade on natural gas that I'll post on the site, of course, if that happens. So that one, just to kind of update it. Again, it's a closed trade, so when I say updated, just kind of where it's at. Got pretty stretched. Remember, that was a total of about a 15-16% drop. So we were in right on the sell signal there, out at T4 and or that day. The T4 just kept going, and so just an oversold reflexive bounce. And again, well, whether the next objective entry is long or short, like I said, if we can get down here and crude gets to where I highlighted in yesterday's video, that may be the next objective long entry. So right now it's in what I call no man's land, really just kind of flopping around. So that other than that, for this week, gave you two trades. The NQ short yesterday, I'm going to get to that at the end. There was a comment that I replied to this morning, or a question. I'll get to that when I cover the indexes. And then the wheat trade yesterday, and I want to highlight that one is, I'm not throwing a lot out there right now because I don't have a high degree of confidence and just not seeing good trades with nice RRs other than the ones I'm sharing on the homepage. Still very much like the Nasdaq 100 short. I'll get to that again in a second. And then the wheat trade is both, as I've been stating for a while now, based on, again, I just covered it yesterday in the video, so really not much updates. I'm not going to go to that long-term chart. Remember, we're coming off a multi-decade primary uptrend line tagged at these lows as well as the low last year. So there is certainly the potential, as I've said, to go to those much higher, longer-term targets I have on that wheat dollar sign WEAT wheat weekly chart, that the weekly long-term chart of the continuous futures contract. This is just an ETF trade. So I just want to update that we took out R1 zone, we took out R2. That's what that means. First resistance zone, popped above it, popped above the downtrend line, popped above R2. Nothing but buy signals lately. And again, so these are just near-term swing targets. If you're new to the site, the reason I'll list these, to me, they just weren't, it wasn't enough meat for me to consider, based on the scope of the pattern and everything. Again, if you want to take profits, any of those are resistance levels, but they're levels I just note as resistance levels that once taken out are going to increase the odds we're going to go to these levels. Again, not a whole lot of meat on the bone to go up to R2. You're talking 3%, 5%. And this is wheat. Wheat is about in line with the Nasdaq 100 regarding volatility. So, for example, if you took this trade, you're up about 4% or so right now. And if you took the Nasdaq 100 short, you're about flat. So this is just again, we don't have a lot. I don't have a lot of diversified bets to spread right now because again, it's a function of just not seeing some charts that I really like and feel right now, other than those that I'm sharing with you on the homepage. So there's wheat, still looking good. Once it starts an uptrend, sometimes you get some pullbacks to support. You can always re-enter on those, and sometimes wheat can really run without and get quite overbought before it has a nice pullback. Right now, it's just early on the breakout, so that's it. We'll continue to watch it, and again, stops will be commensurate with your price target or targets. What I mean by that, some people like to target the early targets, some like to target the higher targets, some take partial profits at each level. So everyone's going to have a different stop on a trade like that. Okay, so that brings us to the only other trades this week. Let's talk about this QQQ short-term trade, and then I'm going to I'll segue into Treasury bonds on it. So let's go to the charts here. I have that on, I think, board 6. Here it is, board 7. So let me go to that reply. Somebody asked today, was it this one? Yeah, it would have been the most recent post here. First comment I saw this morning was this one right here. They backfilled the gap in the first 40 minutes. Would you short here again? Yes, that's just a resounding yes. I think that's objective. A near or full backfill of the gap today provides objective short entry or add-on, as we're still below the uptrend lines on those intraday charts. That's the 15 to 120 minute charts that they broke down below yesterday. In fact, QQQ is currently back testing the trend line from below. The trend line, once uptrend line is support, and then when it's broken, any support level once broken then becomes resistance. So that's what that is. And as per yesterday's video, any marginal new high this week will only extend the existing divergences, so additional back tests will also offer objective short entry. Here's the 15-minute chart of the Q. So you can see that's this again this morning. There's a breakdown, back test, and should we go up a little higher before we reverse, it will in no way, shape, or form change the technical posture from where we're at right now, as long, again, as we remain below the trend line. So I always say that one of the problems, for lack of a better word, if you will, about shorting backtests on trend lines, whether it's a bullish breakout of a downtrend line or a bearish short entry on a break of an uptrend line, is that you can continue to test it. And unlike horizontal price support, when you test horizontal price support, you're coming at the same level, right? And that, if you're patient, that could take weeks, even months. And then you're not going anywhere. It's at the same level. Uptrend lines and downtrend lines have a positive or negative slope. A downtrend line has a negative slope. That's a rise over run. Uptrend line has a positive slope, right? And so that means every day, every hour that you backtest you're coming in at higher levels. However, with that being said, that's just how it works. I would say a very good percentage, it all depends on the security and the conditions in the market at the time, but a very high percentage of breakdowns of trend lines or breakout of downtrend lines, they do back tests. Some just go straight down, hit the first target, and then continue on, and just as many seem to go to break down and back test. So that's it. You can see the arrows. As always, my dotted arrows are, an alternative scenario that's still bringing the same place. I'll never, if I post wishy-washy, it's, if I post red and green arrows, I'm talking about a trading range here, for example, and I might say, look, an upside break is going to be bullish. Well, that's not my arrow tool. Upside break will be bullish, downside break will be bearish, and then react to whichever one happens. This all has us going to the same place, T2. It's just a matter of we're going to go up here. Now, and here's what happens. If we go up and we take back the downtrend line, solidly back above it, especially on a 60-minute or even better a daily closing basis, then that really chips away at the case to be short. And that's where your stop might want to be, depending on, again, where you shorted. Or if we go up and we just continue up and these divergences are burned through, I'll say this, at that point, we're going to be so insanely overbought in the market, if it happened anytime soon, that we're going to get at least an overbought correction. But again, I'm just speaking right now, facts. So the question was asked, and absolutely any back test of the trend line, as long as it's this week, because if it is this week, it is 100% guaranteed to still keep that divergence intact. This is just a 15-minute chart. I gave it to you yesterday on the 60-minute chart right here, so you can see, and that's the same trend line. And again, that was covered in the video, that should we go on to back test, which is, that's all we're doing right now. And also, this was the BOD, or the benefit of the doubt support level. You have a comparable level in SPY that needs to be taken out. So we've been dancing on this support level. And so your objective short entries are any back tests, including this one right now, and or a break down below that 514.39 level. And that should bring us to these targets, which I still maintain, still very much like this trade. And that's why I had these trend lines kind of up like that yesterday in the video. Showing that we could very easily go up a little bit more, but it's marginal. I see minimal upside left right now based on the technical posture of the charts. And then if something else happens, that's what stops are for. You decide where you're targeting. Again, there's potential for this trade to have a lot more, especially if T2 is taken out, because that'll be a pullback to the 200-day moving average like I talked about yesterday. But if you're just swing trading, and I even gave a suggested stop yesterday, was based on T2 using a favorable risk-reward ratio. All right, so now, before I get away from the equity markets, I just want to reiterate IWM, the small caps, in their current technical posture. They also offering an objective short entry. And one of my favorites right now as far as indexes go, especially if what I'm about to get to on Treasury bonds, if that scenario continues to play out. And that would be, well, I'll get to that in 1 second. So it's just a nice clean downtrend line off the highs in IWM. Again, you can view it on the daily, weekly chart. This is a 60-minute chart. Divergent high, and you have a little trading range here. So what you want to see on the smallies, they have broken down. Let me zoom in nice and tight. So that is a breakdown below the trend line. That is a sell signal, any way you slice it or dice it. You also have this trading range I boxed in. That's the recent lows. That's comparable to the level I just gave you on QQQ and on SPY yesterday. We have some minor price support. Again, what I often refer to as a BOD, or benefit of the doubt support level. So if you are adverse, and I know there's a few certainly vocal on this site that think the market will go up forever, there's, if you're, let's say you want a level for stops on your longs, or you want to short, we're overbought and at least going to have a little overbought pullback, but you want to play it safe. In other words, you want to be the second mouse that gets the cheese, then you can wait for the BOD level. For me, it's more of a, do a little short a little here, short a little when that level goes, and then have a full position for that swing trade. And again, I'm speaking the shorter term swing trades right now. Long-term trades I've addressed quite a bit recently in my trading plan there. All right, so that is IWM. I'm just fixing these divergence line. Big divergence there at resistance. And now, I'll finally get to what I was going. Talk about bonds. And so what we have now, we do have on, this is the yield of the 30-year Treasury bond. You have this big divergence forming here. And so if that does play out, which quite often it does, then you're going to have a pullback in yields. I mean, bonds are rally, and that should be net bullish for the stock market, except I always put the big asterisks here. So falling yields, especially from this level, remember, we're in spitting distance of breaking out to new multi-year, even maybe multi-decade highs in Treasury bond yields. That is huge, in my opinion, okay? We haven't done it yet, but we're right there. Again, use the word spitting distance. We're that close. So now, so this abatement in yields, should yields fall? Well, if it's on organic natural forces and not a stock market starts to really take note, as I'm about to get to in a second, and starts a pretty impulsive leg down, you'll see yields fall with a flight to safety bid as institutions go into treasuries. That is not bullish for equities. Again, if the reason for it is equities are falling, breaking through support levels, the aforementioned support levels, the 200 days, the uptrend lines on the indexes, everything else. Otherwise, If it's what I call organic forces, Treasury yields are just coming down on their own, then that could help support new highs in the stock market. Again, any new high anytime soon, even all the way out on the daily and weekly charts. There'll still be a marginal new high, but either way, you'll have to decide how you want to be positioned, if at all, for that. All right, so that's TYX. That's just a 60-minute chart when I go to the daily. And more importantly, let's just go out to the long term, the weekly chart. Again, any new high anytime soon here, or equal high. I just got to zoom in for you here. There's your previous high. Again, as stated before, this high that we had back in 2023 took the 30-year bond to levels not seen. I'll put the crosshairs here, since all the way back, crosshairs are going to tell me right here, in 2007. That's right when the financial crisis started. So this is a level right here that the market started to wobble, and we had a big shot across the bow in 2006. Market rallied up, and again, we're looking at treasuries here. The yields got there again, and then that was the financial crisis. Yields dropped because there was a flight to safety in treasuries, and you also have the other impact where the economy, the stock market was falling, therefore economic growth expectations, hence where rates will be in the future, drop as well. So in bear markets, you'll almost always see yields drop. So that's it. And again, we're very, very close there. Remember, we had 3 rate cuts last year, and the opposite of what has always happened in history happened this time around, showing the Fed has lost control of the long end of the curve, and that's one reason they've been hesitant. They got checked by the market. And so that's why they've been, in my opinion, a big part of sitting on their hands and afraid to really do much at this point in time. So there it is. We'll watch these yields. Again, that's the 30-year. Any new high will be a divergent high, but there are instances where if market forces take over, and I'm not the only one talking about this, the bond vigilantes, you guys read the headlines, you know what's going on. Trump's trying to push through his big, beautiful bill, which is will only further add by almost all metrics, unless he's trying to spin something, it will further add to the U.S. deficit, which is already record levels now, especially running wartime deficits in the peacetime, which is unusual, very unusual. So that's it. We'll watch that, and I'm going somewhere with this too. We're going to wiggle our way down to the 10-year here. There's TNX, the yield of the 10-year Treasury bond. It's a little bit below its high because you see right now we have what they call the term premium on the 30-year. Again, there's been just a increasing awareness of the fact that the U.S., that we're on an unsustainable course with our debt to GDP ratio. And you're reading more and more about it, hearing more and more about it, and you're also seeing it with your own eyes. That's why the 30-year yield is running up and threatening closer breakout, because the longer you lock up, who wants to lock up 30 years when there's a good chance the U.S. will default? Now, it won't not be an outright where they stop making payments. It'll be a technical default. They're just going to print more money, like a Ponzi scheme, to make the interest payments and debt, and therefore they're devaluing the dollar and whatever. It's not, most people don't want to lock up for 30 years with this situation. And so you can see if we do break out, which I suspect we will, to new highs and yields. If we do 5.3, I covered this the other day on the 10 year as a key level. It's a little bit above that recent spike high, but if we get to the 5.3 yield on the 10 year, as I mentioned, it's you skim those 2 highs right there, those peak highs. It's going to take us back to yields not seen since the dot-com bubble. Some of you listen to my voice and might not even have been alive back then. And if you think that will not have an impact on the stock market, we can just agree to disagree. That's all. So that's a big level. Now, we're not there yet. This could go the other way. Anything's possible. And now let's go down to kind of what I wanted to get to here. So IEF is the ETF that tracks the 10-year. It's labeled as a 7 to 10 year. Remember, an ETF, if you can buy a 10-year bond, if you buy a 10-year bond today, a year from now, it's going to have 9 years left on it. And to keep expenses down, just like TLT tracks the long bond, but it's stated as the 20 to 30 year Treasury yield, because they're going to hold those bonds and then roll them when they get down around 7 years. They're trying to target, track the 10-year bond, but again, you can't go buy further than 10. They're buying these 10 years probably at the auction and then rolling them out. So this is, again, you're tracking the price of the 10-year bond, well, for all intents and purposes. And this goes back to, I'm going to pull up, I have some charts here. I started covering this, I believe, as with most things in videos. I checked back. I have charts as early as early February of 2024 when I started listing these zones. I made one tweak about a month later. I moved the zones a little bit based on, these zones weren't just random. They're based on support and resistance levels and my interpretation of what would happen to the stock market. And as the zones, clearly state, yellow zone, and I had since later added a green zone up top, meaning it's fine. Remember, because when the price of the 10-year goes down, that means yields are going up. So the yellow zone says the stock market will start to take note of rising yields. What does that mean? Well, exactly what it means. It's just going to take note. It's going to slow rallies down, start wobbling a little bit. And then orange zone, once you enter that, the stock market will really start to take note of rising yields. And then if we get down to the red zone, which we haven't done yet, stock market will start to freak out. So that was, as it was initially laid out, I made one adjustment to it back in, was this it right here? Yeah, it looks like I changed that yellow zone down to 93.43 back on March 12th. So I tweaked it a little bit, again, the zones. And now let's just talk about that. Let's see where we're at now and let's see what happened again. So I put a lot of stock into this, and similar to my sentiment indicators, we've had a lot of trades, and we've batted probably 800 or better on trading treasuries in the last couple of years. A lot of longs, a lot of shorts, probably an equal number in both ways. That if you look back, you can see those trades on the site. And this is a great example of why I like to swing trade, why it's profitable. An investor has gone nowhere. Even though bonds kick out interest, the yields are very low. We're talking a few percentage points. It's taxable income on treasuries. So give a third of your money away to Uncle Sam of your interest. And you can see it's just been a grind, but it's been a swing trader's dream. And these bonds, they trade so well to the technicals, at least so well to my style, looking for support, resistance, trend lines, bullish chart patterns, bearish chart patterns, divergent highs, divergent lows. And again, more of the takeaway here, I know it's hard to see if I turn off all my annotations. I need them here, but here's your yellow zone. I'm going to box them in using the box tool just so you can see real quick. Green zone, and again, this is how they've been since I think early 2023 after making that one adjustment in March. We have a green zone up here, which is net bullish for the stock market. There's my caveat, if you will. Any advance due to a strong stock market sell-off will be a flight to say if any advance due to a strong stock market sell-off, will be a slight safety bid, and that will be net bearish, not bullish, as I addressed a minute ago. And then I also went on to say back then, impact on the economy and the stock market is both a function of the price level. In other words, remember, the lower this goes, the higher rates go. And the 10-year is really the one to watch if you're only going to watch one bond. The 30 is important, don't get me wrong. I watch all ends. I watch the short end of the yield curve as well. And so the impact on the economy and the stock market is a function of price level as well as the time below the green zone. Okay, so the longer we stay down here in the yellow or orange zone, that means the longer we have elevated rates, elevated to where they've been historically. Remember, the Fed went to a zero rate policy back in 2008. It allowed almost every individual out there alive today and every corporation alive today had multiple opportunities to refinance their debt, their cost of capital. That's for you and I, mortgages, car loans, boat loans, whatever you got, personal loans. For corporations, it's your business loans. Bigger corporations sell bonds, which is debt. And so again, the longer you stay up here, remember, we're zoomed in on I'm on a 2-hour time frame, 120-minute, just so I can go back to where I started doing this back here in the beginning of it goes back to 2024. And so remember, this is elevated yields. You're only looking at it going back a couple of years. So this is where yields are pushing out. If we break this, we're going to break out. That's the breakout to new multi-year, even multi-decade highs if IEF drops here. Okay, now where I'm going, there is a point to all this. Here we are today. This is why I'm covering this along with the equity markets. We are now flirting with, there's that 93.40 again for months now. I've covered that. We can go back. I'm just going to pick a random chart. Let's go back to, that was 2024. I'm on a different screen. That's as I'm talking. I'm not doing anything on the one you're watching. I'm just pulling up an IEF. Let's go back to, well, let's take a look at this. We dipped into it right here. And then we got into it there. So let's just talk about the times. Let's do this. Let me write this down. We'll do it this way. I'm going to go through here and talk about the time. We're going to highlight the times it's dipped into orange zone because that's the whole point of this video. We're flirting with, we are in my yellow zone. I'm going to box it in for you again. This is the yellow zone that I'm boxing now. Yellow zone says stock market starts to take note of rising yields. Orange zone says the stock market really starts to take note of them. And of course, red zone's where it freaks out. I created the red zone after that. We had a bear market back then. Shortly after it hit there, we had the 2024 bear market. And so that was the catalyst for it. Yields breaking out to new highs. And then boom, the bear market followed. This is when the Nasdaq, if you're not familiar, the Nasdaq peaked back then in late 2023. Okie doke. So since this point back here, this was the last time we entered that. We're going to do this one at a time. So we have, as you can see, the months are down here. This was November. A couple pierces there, pierce into it in November, and again in December. All right. So let me pause this. Click over to QQQ. Yeah, I don't need to pause it. Just go to QQQ. Let's just turn off all the lines. Stay on a 60-minute chart. All right, there's November through late December. This is when we started punching down in through there, and I told you one more again in December, right? That was it. That was the high. That's when the stock market peaked. It tested that high again, but it did not go any higher. So again, this was predicted back here. That was we'll go back to TLT. You can see we had the biggest drop. There was a little bit of lag time there, but again, it was those persistently high in the touch of that level. Again, not tweaked since over a year ago. IEF, go back to IEF. Oops, IEF. All right, so, all right, we covered that one. All right, here, the November and then the late December dip that coincided with the high in the stock market. We went down. That was it. The damage was done. So therefore, let's check mark as far as track record goes. Remember, so we were down there. We started testing right here, and you can see this is the first punch down into the orange zone, and that was back in looks like early April right here of 2024. Okay, so no punches down in. This is when we went in, so that doesn't, that's what we had another visit down there. I'll get to, okay. So we exited and then had a visit there in July. So let's just focus here as April right here. The first punch down in, we went well down into the orange zone. We exited the orange zone here for a couple months and then went back into it in July, early July. So early April, early July. Let's flip over to QQQ. Turn off all those busy lines here. I'm on a busy board. QQQ, early July and early April. Okay, guys. So as you can see here, my indicator, not a hindsight indicator, laid out way back here so far, and I just covered this one, picked the top, got all this, has been 100% effective. So let's just see. Honestly, I'm doing this live right now. I don't know if I didn't go back this far. I just glanced at it earlier. I wanted to cover that because I knew we were coming up in the orange zone. Let me go back to IEF. So, okay, so that's it. So far we've got the biggest drops in years, and this is swing trading. This is what you want to do. You want to get in, find a reason. Again, if you think that's just random coincidence, again, we can agree to disagree. Having a background in finance and economics, I know that rising yields, and there's that threshold. Again, it's like my sentiment indicators that I use. I say they're garbage and useless unless they're at extremes. Same thing with my 10-year bond indicator. It needs to hit these levels, otherwise it's noise, and that's why I don't do. That's why I haven't highlighted those levels. I don't highlight them on a weekly basis, but I'm certainly highlighting them now because IEF is testing that. And just a week ago, I said keep an eye on treasuries, and then of course we had the Moody's downgrade on last Friday. So let me turn back on my lines. And okay, that was it. Yeah, that was it, guys. So since I started laying these out back then, again, I'll admit it's a small sampling point. If you're, a statistician, you know that, okay, well, you have 2-year period and only a few hits. But again, I'll also say this. You'll hear about it on the media. You did back then. They start talking about the impact when yields start getting to this level. So if we enter the orange zone again, we'll see. And it's aligning right now with the, at least that short-term pullback trade, which can be more. And remember what I said before. This is a function of the further you get into the orange zone, the greater the impact is going to be. So right here in the beginning of January 2025, you can see we got down here, and this was the flight to safety bid that I talked about in bonds as we had that big correction earlier this year. And so far from mere coincidence, these line up with the technicals on the stock market. And so now nothing's to say we can't bounce here. And if we do that, and as I said, if it's an organic, natural, abatement of yields and a rise in treasury bond prices without any, stress on the markets or anything else, yeah, that would be help to support the case for new highs in the stock market and may foil this current QQQ short trade. But if we do this, that's going to, every tick, every day and every tick lower into that range will put further pressure on the stock market as it had here, 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 and here. Those are the previous times I mentioned it. Okay, so that's about it. You know what? I'm going to wrap it up here. I'll update if anybody asks. I'll update, like I said, on GDX. We hit that T2, looking for a bounce there. We got a bounce. Probably run its course. I don't have a strong conviction right now. The dollar's pulled back a little bit. The dollar's still off its that low, that long-term support level I talked about. Still in a near-term uptrend. I'm watching this, and again, if we get this, if we start moving down in here, and I suspect it will happen fast. I said it yesterday when that trade, when I put it on. Today, the recovery we had, it's more of the same lately to see a nice intraday recovery. QQQ has been doing this lately. That's a 1% turnaround. But again, as I started the video, nothing's changed in the technical posture. The breakdown has happened. We're below the level. We're pretty much reversed off the, right above that first support level. There's that chart I gave you yesterday on SPY. What did I give you yesterday? 55.80.60. There's SPY. It broke down yesterday right there, as I talked about. And today we hit a low of 588.42 versus my 588.60. So you're talking 18 cents on a almost $589 security. You're talking mere fractions of 1%, mere basis points. So that's a near perfect hit. Reaction exactly where I expected it. That's the first support level. It's a good support level. Q's reversed a little shy. So that's, I just want to reiterate, nothing's changed. And yes, I think the kickback and QQQ is the proxy. QQQ and IWM are my two favorites. And we're not going to hit T1 or T2 on that QQQ trade until and unless this level gets taken out right here. And the one I gave you, the comparable level on QQQ, I have it on two boards. I have it at 514.39 there, and on my 15-minute chart, I have this one right here, 514.39. I guess it's about the same. You can see it right there. And there's a 15-minute breakdown backtest. This is the one I posted in that reply, that comment reply this morning to someone. So we need to do that. I would set a price alert there. This is, to reiterate, an objective entry in my opinion, as was yesterday's breakdown. As is this, and as will be a 514.39, and then after that, no more objective entries, in my opinion. That would be an all-in short. Increase the odds, I would say, to 80+% that we're going to hit at least my first target, and quite likely my second. And so that would be your, 1, 2, and it could be 2. You know, when I say 2, being the back test, as long as we're back tested, not above it. Objective entries, and then 3 finally once 514.40ish goes. I'll even go so far as to say I put a good odds. I think today will be a red close, and you'll see this this post opening rally get faded again, just based on my read on where we're at on the charts and everything. And so that would be now if T2 is hit yesterday. What I tell you, 5.5? It's still 5.5%. Oh yeah, because that's right. That's right. The initial short was in anticipation of it, so we're right about where yesterday I said my preferred entry was in a breakdown in advance. I'm sorry, a short in advance of the breakdown, because I thought the probability was high enough that it would happen, and has happened. And so all I see are check marks. I know others see a market that won't go down, and you know, again, it hasn't gone down yet. Many over here saw a market that wouldn't go up, couldn't catch a bid for anything, and so I just see the same thing in reverse right now. And this is like I said, first time in 2 weeks plus that I think provide an objective short entry on QQQ. I told you before on the daily chart I would stop, and again this was long-term swing positions, would not add and haven't added anything above that 200-day moving average. And then obviously based on my outlook now, I told you on the long-term positions that I would take another half of the position out if we went over last Thursday's highs by a fair amount. And based on my current take, that has changed. I'm going to hold tight no matter what happens today, tomorrow, see where we go this week, because my confidence is high enough on this swing short that at least that's going to play out. And so I'll be figuring out what to do if my 5.5% pullback targets hit. Do I then hold tight or even add to? And I can tell you right now, my swing positions, trend positions that I'm targeting T7, which is way down there, I don't plan to cover them at all. If we hit there, I might cover that, and will almost certainly cover my swing short in the active trading account if and when T2 is hit, the game of bounce. But those longer term positions, no, I'm still in a position where I'm either going to add to or subtract those positions. Subtracting meaning if this thing plays out, something else happens here, we start burning through the divergence, or take back the trend line like I told you on that 15-minute chart and 60-minute chart. But I'm also waiting to see and expecting a good chance that we're going to take out the 200s. And if that happens, it's going to be a powerful technical event. And I think it'll be a strap in, hold on for the ride. And if you wait just a few days, you probably miss one of the biggest drops. And again, it hasn't happened. I'm predicting what will likely happen if and when the 200 is taken out. And it is my preferred scenario that will most likely happen. And then when that happens, I think you'll see it'll be gradual at first, because most traders will allow for an undercut of the 200s. And then the farther you get away from them, and like I said, I've been saying this all along, lights out. If we go back below my bounce target zone, 466, that would be my all-in for that long-term swing trend short position there. And that should take us down to, where did it go? There it is, T7, the old T7. So T7, if hit, will be about a 50% drop from where we are, and still, as I maintained, about a 55% drop from the highs right there. All right, let me wrap it up, get it out to you guys, and I'll continue to do updates on these. If you want updates on anything else out there, anything that I'm not watching, anything you're watching, let me know. Like I said, it's I've got plenty of time right now. I'm just gonna sitting tight, being patient, and waiting for this one to play out or not. And if it doesn't, again, move on to the next one. This trade's break even. WEAT is up, several percentage points. Far than even if you shorted QQQ at the absolute worst time, took it there, and you're underwater, you would have made probably 5, 6, 8 times that so far on taking the WEAT trade the other day. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.